Good day. You're about to listen to an Intro to Cost of Production screencast, and my name is Kathy Larson, and I'm the beef economist with the Western Beef Development Center. During this screencast, I'm going to give you some information on cost of production. Just a little bit about a Western beef's cost of production history. We've been working with producers, Saskatchewan cow-calf ranchers across the province of Saskatchewan since the late 1990s. We've generated annual cost of production benchmarks that we share with the industry based on actual rancher data from across ranchers that have participated from across the province. And these results are available online for anyone that's interested. And you can find them on our website at www.wbdc.sk.ca. So first off, what is cost of production? Cost of production is essentially a sum of the resources that go into producing a product, and those resources typically are land, labor, and capital. When you do cost of production analysis for your cow-calf operation, you need to consider both cash and non-cash expenses, as well as cash and non-cash revenues, and I'll get to that in a second. And it's calculatable for all your business lines or enterprises on your ranch. So what do I mean by that? A ranch is a collection of businesses or enterprises. So if you think of your own operation and you have a cow-calf business, plus you keep back replacements for the development of bred heifers for your own herd, you keep back some calves, background them, and sell them in the spring as feeders. You have your own pasture that your cattle graze, and you have your own hay land that you use to produce hay to feed to your livestock. You essentially have 5 business lines or enterprises. And each of those enterprises actually has its own cost of production. You need to sort through your revenue sources and your expenses into the various enterprises on your operation. And there's going to be expenses that are shared. You can think of fuel, for example. It is going to be an expense that is not attributable to just one enterprise. It actually is used by every enterprise. And so an exercise called allocation, where you split or percentage out the expense across the responsible enterprises, needs to happen. And then generally we do that inside of a calculator of some sort or a software program. And I will be creating some additional videos to show you how to use Western Beef's cost of production calculator. And the reason you want to do this enterprise analysis and treat each of your parts of your operation separately is you can determine where you're making money on your ranch and where you're losing money. So who are the winners and losers on your operation? When it comes to revenue generation, sometimes it might not be easy to initially think of where you're actually generating revenue for some of your enterprises. So on your cow-calf operation, yeah, you might be selling culls, cull bulls, cull cows. You might be selling calves at weaning time and you're actually getting cash generated. But there's something like hay or pasture or replacement heifers, it might be hard at first to see how those are generating any sort of revenue. So you have to think of non-cash revenue. So what I mean by that is for things like homegrown hay that your livestock consume, you make those livestock pay market value. So essentially what you could sell the hay off farm for. When it comes to your replacement heifer enterprises, your cow-calf operation is going to essentially sell calves to the replacement heifer enterprise and eventually buy back bred heifers. Backgrounders, they're going to be buying calves from your cow-calf operation, paying market value for what those weaned calves were at time of weaning, and then they'll be eventually selling them to the open market or perhaps transferring them to a grasser enterprise on the same operation. Here is a table trying to just to give a snapshot overview of a ranch with 5 enterprises. So each column represents an enterprise, and the first blue row is the primary source of revenue for each of those enterprises. So the cow-calf enterprise has weaned calves as the sole source, the primary source of revenue, and so on and so forth. Underneath that is a bulleted list showing some of the expenses for each of those enterprises. And what's more important is probably in the next slide here. I've done some color coding to try and show the assortment and array of expenses that accrue to any enterprise. And you can see there's going to be some enterprises that are livestock specific and some that are land-based specific. So specific. So for feed, that's something that's only attributable to the livestock expenses. And under the hay and pasture, if you look all the way to the bottom of the slide, you'll see property tax. So property tax is generally an expense that accrues to the land-based enterprises. If you look at the top of the hay column, you'll see twine listed. Twine or net wrap, that's a hay expense. You don't charge it to the cows because they're just going to pay market value for the hay that's produced from your operation. So when it comes to cash versus non-cash expenses, we've just finished talking sort of about cash and non-cash revenues. Cash expenses are those that are found in your accounting records. Non-cash, there's actually no physical outlay of cash. They're often sizable and very important to consider, and we consider them inside of cost of production analysis. Those would be the deeded grazing, so your own land that your cattle graze, and your homegrown feed. And we've just talked about how you're going to make your cows pay fair market value. So essentially what you could sell that, rent your pasture out for, or sell your hay off your operation for. Unpaid labor is another non-cash expense, as is depreciation. Just further again, homegrown feed and grazing, you're going to charge market value for your feed and grazing. And the reason you want to do that because ultimately you could sell all your cattle and simply rent out your pasture and rent out your hay as standing hay, or perhaps make hay and sell it off the operation and have no cattle at all. So you need to, if you've made the choice to have livestock on your operation, you need to be making them pay what's fair. And what's fair is basically what you could get for its alternative value, so the market value. Double counting concerns shouldn't be an issue if you are doing your allocation properly. So if you're making your cows pay market value for hay, then they cannot also be charged any of the hay related expenses like twine and baler repairs. Those are expenses that need to be charged 100% to the hay enterprise. When it comes to unpaid labor, I usually like to talk in terms of just first off saying if you do not have an off-farm job, ranching is therefore your full-time job. A full-time job, as I understand it, is 40 hours a week, 52 weeks a year. Give or take a couple weeks for holidays, and you're looking at about 2,000 hours a year. The average hourly wage rate for primary labor in Saskatchewan in 2012 was $25 an hour. So primary labor accounts for agriculture, forestry, fishing, and mining. 2,000 hours times $25 an hour, and you're looking at $50,000 value for your labor each year for working in a primary labor sector. So collectively, can you ask your ranch and all of its enterprises to provide $50,000 in wages to you for the value of your labor? One of the last non-cash costs I'll discuss is depreciation. So as your assets age, they essentially lose value and eventually need to be replaced. So if you account a little bit each year for that decrease in value, that's called your depreciation, and your assets are your buildings and equipment. And when we do cost of production analysis, there's some sort of standard percentage rates that I've used in tools and work that I've done in the past, and I'm just going to stick with those and suggest that you do as well. When you get into Western Beef's cost of production calculator, you can alter those values higher or lower as you see fit. But these are the suggested rates. 5% on buildings and livestock equipment, 8% on machinery that's powered, and 11.5% on non-powered. Now, what is unit cost of production? Unit cost of production is basically one step further than cost of production. So in terms of cow-calf, it is determined by taking your total herd cost and dividing by total pounds of calf weaned rather than number of cows wintered. So it yields a price dollars per pound of calf weaned as your cost represented in that manner. So typically cost of production, you will read and hear people talking in terms of dollars per cow when they're referring to cow-calf cost of production, perhaps dollars per head when referring to backgrounders and replacement heifers, dollars per bale when referring to hay, or dollars per head per day when referring to grazing or pasture. Unit cost of production would be dollars per pound of calf weaned. It's basically taking your costs down to the primary unit of production, so the primary item that's being sold. By doing this calculation, you're essentially getting your break-even price, and that allows you to compare yourself with market prices that are posted. So if you know your unit cost of production for your cow-calf enterprise, you know the price that you need to sell your calves for. And if you know their average weaning weight, you can go to posted market prices for that for that weight class and see if you're going to be in a profit situation or a loss situation. When you're talking about feeders, you probably want to talk all the way down to dollars per pound of gain, so your cost of gain, and forages perhaps all the way to dollars per ton or dollars per pound. Unit cost of production essentially ties production into your cost of production. Here's a scenario to try and make that make sense for you. If you have 3 ranches and they all have the same cost of production and all have the same average weaning weight, they could all require different break-even prices. If they all have $600 per cow and 550-pound calves, it really will depend on how many of those cows wintered a calf. So their calf crop percentage. So if 100% of their cows weaned a calf, they only need $1.09 for those 550-pound calves. But if only 90% of their cows wintered weaned a calf, they would need $1.21 for a 550-pound calf. So that's why it's really important to not just talk in terms of dollars per cow, but in terms of dollars per pound of calf weaned. The next video will be on details required for cost of production analysis for your ranch.